Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Jan Brzeski, and today I'm with Greg Hebner of Arixa Capital. We'll be discussing real estate lending as an investment strategy. Well, Greg, it's nice to see you. You and I have been working together for many years, but today I'm going to be interviewing you about the investment strategy that Arixa uses to generate returns. So for starters, give us a little background about yourself and how you got into what we're doing now.
So I've been a real estate investor since literally right after the graduation from college, and ended up getting my mortgage license and being involved with some mortgage companies in the 2000s. Pretty long arc of being involved in a lot of aspects of real estate, seeing how real estate can be a good investment for myself, friends, family, and finally you and I working together on the funds that we operate.
Terrific. And how would you describe Arixa Capital and what we do at Arixa?
Arixa Capital operates two separate lines of business. Our lending business develops relationships and builds relationships with borrowers who are real estate investors, developers, who are acquiring, renovating, repositioning, or adding value to single family and multifamily properties. They are investing their own money or raising equity to do those projects, and we're providing a percentage of what it is they're going to purchase or acquire the property for, and a percentage of what they're going to spend to renovate, reposition, or add value to it. Typically, we're going to give somewhere around 75% of what the total project cost will be, and the borrower or the borrower's investors will put up the rest of that money. We're going to charge the borrowers interest for the money that they borrow, somewhere in the 7.5% to 9% range, and they're going to pay us a fee to originate that loan for them. We also service those loans, meaning we collect the payments on behalf of our funds and handle all that interaction and things that go on after we actually originate it. So that that's one part of our business. The second part of our business is an investment management business. It manages and operates a number of different private debt funds, and those private debt funds provide the capital and hold the loans that are made from our lending business. Those portfolios could consist of 75 or 100 different loans, all with different maturities and various borrowers and geographies. And those funds are collecting the interest that's being paid every month by our borrowers. And then we remit that money to our investors, second, third week of every month, or reinvest it if our investors prefer. But those funds are established to allow limited partners to own units in a fund that's going to hold a number of different loan investments and collect those payments and deliver those as returns to our investors.
So why is there a need today for the type of business that you have? Don't banks make loans? Why is this business needed?
Yeah, banks definitely make loans. Banks do not like or are set up to work at the speed and pace and creativity that our borrowers demand. Banks are, they want to hold loans that have a long maturity, meaning they're outstanding for many years. And typically they like to do loans on owner-occupied properties, which we do not make. Our loans are made to investment properties only. We don't lend on principal residences. And they aren't set up to do a lot of construction or follow-on lending. So the process by which banks look at these loans makes it very difficult for the borrowers to get what they need to complete their projects. So although it would be cheaper in terms of the interest rates, substantially cheaper, our borrowers have found us to be a much better solution for what it is they're trying to do. Part of it is speed. Part of it is certainty that they will receive the funds when they need them. And also the flexibility to understand and be able to fit the borrower into what they need to complete the project while still protecting our investors and making a safe loan. We don't have to be so formulaic. Our loans don't go to the government or into some sort of security. It lets us be what I call common sense lenders, understanding the risk, understanding the benefits, and making a good decision, which we've done now a couple thousand times over the last decade. So I think, I just think banks are they're just very challenged to be able to make the kind of loans that our clients expect us to make.
Great. And let's talk about one of those investments. Can you walk us through a typical loan or a recent loan that comes to your mind that Arixa made?
Yeah, a couple just that we funded over the last couple of weeks that were sort of fresh in my mind. We do work a lot with borrowers on a repeat basis. It's 75 to 80% of our loans come from repeat borrowers and folks we have lent to before. Recently we had a borrower call us up. They were buying a property in prime Brentwood. It was a very competitive property and they needed to be able to close very quickly. In this case, in under 2 weeks. We provided a proof of funds to the borrower and made a 75% of his purchase price bridge loan. That loan was about $2.8 million. The borrower had put in about $900,000 of his own equity. And that was going to be a bridge loan for about 9 to 12 months until the borrower is ready to do his construction on the property. It's a good property in good condition here in LA. We had another borrower who had done a couple projects down in Orange County, found a property that he wanted to add some square footage to. We lent him also 75% of purchase and 75% of his rehab. That property will be worth about 2.1 or 2.2 when he's done. Our loan will be about 1.5, which is kind of in our target range of being between 60 and 65% of final value after improvements. So again, in both cases, our speed was important, certainty of execution was important, and with the borrower doing construction, knowing that we were going to manage the draws and be able to provide ongoing funds to him to complete that project were a big part of being able to serve those two clients.
How would you say that Arixa prices its loans? So how much interest are the borrowers paying? What kinds of origination fees are they paying? Let's start with that.
We are in a very competitive market for the kind of borrowers that we work with, as you know. Our borrowers tend to be quite experienced, active, professional real estate investors. So we certainly aren't the only option that they have when it comes to our product. So we're subjected a little bit to market forces. We've always been able to get some premiums just for the way we deliver our service, but typical pricing for us on a loan will be between 7.5 to 8.75. Most of what we write is going to have an 8 to 8.5% interest rate. The borrowers pay us interest each month, and the principal on the loan balloons when the loan comes due. Typically, our origination fees will be somewhere between 1 and 2 points of the total loan amount. So the borrower's paying somewhere between a 9 to 11% annual percentage rate for the money that they borrow.
I think a lot of viewers might think to themselves, well, I can borrow from a bank for 3 or 4%. Why are people paying you double that for these loans? What are they paying for?
Yeah, and I think that's a question you and I have received, a lot over the years. And for myself, who just recently refinanced a rental property with a bank that took 4.5 months, it was a further confirmation that we're in a good business by what we do. Most banks don't participate with shorter term loans. They do very well with longer term and longer lead times. And both in the single family and the multifamily, which is kind of where we spend most of our time, our clients are looking for speed of execution and most importantly, certainty. And really the banks are just not able to respond on the type of products that we do. So many of our borrowers are very bank worthy. I think one misnomer as well, they're paying you 8 or 9 or 10%. Are these borrowers, of a lesser quality? We both know most of our borrowers have a number of banking relationships. Most of our multifamily loans are paid off through a bank. It really is, our borrowers think of us as part of their basis and their investment in the property itself. And being able to work quicker, secure the project, and being less expensive than equity would be. if you go out and raise equity financing for apartments or the single family projects that we do, you could easily find yourself paying 12, 15, even 20% or more, or share the profits. So, a lot of our clients really want to control the property themselves. A lot of time it's their money, and they look at us as a great avenue to be able to connect the dots and get their projects completed.
And what's the margin of safety on a typical investment, and how do you measure that?
Yeah, so there's really 2 points in time that we're really going to be focused on. So I'll just go through a typical fix and flip loan just as an example. We want to be 75, 80% maximum of cost. As value is going to be added to the property, we want that number to go down. And we do that by reimbursing our borrowers as they invest in their properties and they renovate or improve them. We then follow on with additional construction financing on that loan. So say the borrower is going to put in $100,000 over the course of the project, and we're going to fund 75 of that. Our funding will happen after the borrower has done the work, paid the vendors, and then submitted their draw. And if we're doing the right types of loans, that $100,000 should create much more than $100,000 of value for a client. So at the end, when we actually make the last dollar of our loan goes out, we'd like to be somewhere in that 60, 65, 66% range on final value. And we've been tracking that, you and I, for 9 years now. And it's surprisingly, even though the markets have moved up and down, that number hasn't changed a lot over a couple thousand loans that we've done. So if we're doing that, we feel we've given ourselves 30 to 35% margin of safety on that loan that could be prepared if anything happens in the market, if there's any changes in underlying collateral value.
Could an investor make these types of loans on their own? And what do you think would be the pluses and minuses for an investor doing that versus investing in a private debt fund that makes these types of loans?
Yeah, certainly. One of our largest investors has been doing this for 30 years on his own. So we certainly have seen a number of investors who were individual trustee investors, where they either participated with a piece of a loan and or originated their own. Certainly the advantages are the control you would have. You'd have all the ability to make the investment decision, choose the borrower, and have full active control of that loan, including collecting payments or finding a servicer and handling the payoff and all the things that would go with that. So for sophisticated real estate investors that really want that control and be an active manager of their investment, it's certainly a viable option. The biggest disadvantage, obviously, is all that work, evaluating the property, handling the documents, and knowing that loan could pay off at any time, and then you're redeploying the cash into another investment. So there's a lot of opportunities for cash to come back to you. You'd have to redeploy it. And of course, just the lack of diversification. If you have a $500,000 loan and you have one loan versus investing in a fund where $500,000 may give you access to 100 loans, I just think the concentration risk, if you're not a highly sophisticated and experienced investor or really know your borrower, I just think it's a different risk profile than what we would take in our funds. The advantage of the funds are, you do get a very diversified portfolio. All of our portfolios have, upwards to 75 to 100 individual loans at any time across a number of geographies, a number of borrowers, a number of stages. And we're able, with the income we collect, to be prepared, if something goes wrong, to not have a real impact on the returns. And also, you have a professional management team and a professional staff. We're almost up to 40 full-time people that are working every day to manage those portfolios, work with clients, and make sure that those portfolios are being taken care of. So, we both have lots of friends and folks that we have as investors. And, I think that that's a real benefit to them, that they don't have to spend their time managing an individual loan or individual investment.
Great. I'm going to switch gears a little bit here. What's your favorite thing about your job?
Favorite thing? Well, I think you already know what I'm going to say, but I love being out with the clients and out with the projects that we get to finance. I think it's a real blessing to be a part of this ecosystem and seeing how we creating jobs, changing neighborhoods, really being a positive economic force for a lot of people. I think sometimes we probably don't really realize, but over this last year and a half since the pandemic hit, by us being there, being able to finance and keep our projects going, we kept thousands and thousands of people employed, being able to take care of their family, creating great housing that's much needed. And I love working with the creative minds and entrepreneurs and local real estate investors and business people that we get the pleasure to serve, and seeing how they take their visions, turn it into reality, do it profitably, and create wealth. But we're blessed with a great cadre of clients who are very talented in what they do, not just high-end, low-end, medium-end. They're creative about entitlement, how they build what they do, how they manage their teams. And that's kind of where it's where I get jazzed up. I really enjoy that part of what we do.
And how about the flip side? What's the hardest thing about your job?
I think just growing and being able to scale this business. You and I started with 3 or 4 people and a few loans and a few clients and a few investors, and now it's grown to hundreds of clients, probably approaching 1,000 investors. And I like to use the analogy, we're landing planes every day. It's making sure we meet the commitments, delivered on time, and do it safely. Just got a lot more planes in the air, a lot more planes on the runway, and managing that scale and what's involved with that is certainly one of the most challenging aspects of what it is that we do.
Let's go back to the strategy for a minute. What do you think is the best thing about the strategy that you're pursuing as an investment strategy?
Well, again, we live in a very yield challenged world. We both talk about that a lot. You don't get paid very much for your savings. You certainly don't get paid very much to hold bonds. And our particular real estate niche gives us an ability to use secured real estate as collateral and to generate a current yield and a current pay from the interest we collect on the loans that we hold. That's very attractive. To collect a 7.5%, 8.5% current pay on interest in our levered fund, an ability to even generate north of 9 for our investors, pay that out every month if our investors would like us to do so, and to do it with a margin of safety that's 35+%, and very little loss experience over the last 10, 11 years of doing this. I just think is a really good place. It's kind of a Goldilocks place to play. The real estate market has been very, very kind to us. It's been incredibly strong the last year, which we've benefited from a lot. But I think we've created a group of borrowers that are consistent, they're stable, they're successful, and it's allowed us to build, a very substantial base of income producing loans that our investors are benefiting from. So I look around where you can generate these kind of returns today, and stock market scares us both. The bond markets are just not paying you for risk, and you've got risk of rising interest rates. I think we've created a pretty good mousetrap for a retail investor to get a current income on their hard-earned investment dollars.
And what would be the top 1 or 2 risks if something were to cause a stumble or losses? What would cause that? What's most likely to cause that for the strategy that Arixa is pursuing?
Well, on a loan level, I think the biggest risk is, we do some construction lending, and an inability for a borrower to complete a project certainly would involve us having to get involved. We've done that multiple times. We certainly have a team that's experienced. So I think we can mitigate that. But on an individual loan level, I think that's where a loss could occur. And if it did, we've been building reserves, and we want to be in a position where there would be little impact to our investors. I think macro, rising interest rates are never a plus for the residential market. The low rates that we've had over the last year and a half have certainly fueled a lot of what we've seen in strong real estate prices. Certainly things can happen, but hopefully over the course of the number of loans that we carry in our portfolio, that would be relatively minor for an investor in our funds.
Okay, great. Well, Greg, it's been a pleasure. Really appreciate you doing this. I'm Jan Brzeski, and you've been listening to Beyond Wall Street.